briefly about inflation. I know we have a lot of discussion of that topic. Are you seeing a moderation?
Yeah, we certainly have been calling for that over the last few months, and yesterday's print obviously, I think, verified people's viewpoint. We're in that camp that we think the Fed is done with rate hikes and the hiking cycle is over, and I think yesterday's print kind of reinforced that.
What about oil? Oil rallied a little bit yesterday on hopes that the Fed is done hiking interest rates. Do you see, but oil has suffered lately.
Yeah, I mean, when we saw the invasion of Israel by Hamas, we saw that risk premium sort of come into oil, but that's dissipated completely. We're now below $80, where we were over $80 prior to October 7th events. So it's kind of interesting to see the strength of fundamentals kind of get sidetracked by, I'm going to call it, some sentiment and general concern about maybe where the demand picture might be in 2024 if the economy does slow down.
And I know this is going to come up on the show, but gold, where are you bullish on gold right now?
Yeah, we feel very constructive on gold in the sense that history shows over the last 40 years, gold performs very well. I think the average is about 34% after significant rate hikes. When you start to go into rate easing, you see that kind of performance. So we're kind of looking for that in 2024, where kind of the headwinds of a strong U.S. dollar and rapid rate hikes will dissipate, and now will be overtaken a little more by, I guess, geopolitical risk, as well as this general strength on the demand side for gold.
Maybe we could put up a 5-year chart for gold. I suppose you could argue that gold has done fairly well given the rapid run-up in interest rates. Typically, that's bad for gold.
Yeah, we have these conversations with clients where they say, my God, gold has done nothing. Why are you excited about it? And I actually tell them, well, I'm actually encouraged that gold has been very resilient, let's call that at 1,800 and more recently around 1,900 U.S. an ounce, given all the headwinds of strong U.S. dollar, rapidly rising rates, not only nominal but real rates. So I think the setup is quite good for gold. Once those things start to disappear and go into the rearview mirror, that kind of opens the door for gold, I think, to break through 2,000. I
guess the other side of the coin, though, is gold hasn't really done its job this time round of protecting people against inflation. I mean, it's not really up from 2020, for example.
Yeah, I mean, it's up from 3 or 4 years ago, yes. It's been relatively flat since pretty much the beginning of 2022 or mid-2021. But I think when you consider all those headwinds, again, U.S. dollar, strong real rates, those things are now in the rearview mirror, and I think that kind of opens the door for gold to break through. I'm not saying it's going to 3,000, but I certainly can see it find a new floor of around 2,000 U.S., and I think that's a very important psychological level.
We have an email from Ron. Ron's curious about E3 lithium. Ron says, it appears E3 will be the first commercial producer of lithium in Canada. I'm not sure if that's the case, but that's what he says anyway. Would this be a good speculative play?
We currently don't own E3. It's what I'll call a bit of a technology company because it's utilizing something called direct lithium extraction from old depleted oil and gas reservoirs in Alberta. So it's something new. It hasn't been done successfully on a commercial scale outside of China in terms of using this direct lithium extraction. I think the key for this one is to see if it can be scaled. Pilot plant has been working well, but people want to see it in size and scale so you can make money at it. So we've been on the sideline largely on that basis. Also, I think lithium in general has obviously come well off its peaks, and now we're kind of at that marginal cost level of probably 22,000. So we've been out of the lithium space in general, but it does start to look interesting. But I think an E3 is one that is certainly more speculative rather than an Albemarle or SQM or something like that.
And now we have Exxon talking about becoming a major lithium producer.
Yeah, and it'll be interesting to see if E3 could be successful, the scalability, the application beyond its own footprint. They might patent it and use it for other people's projects and get a piece of those projects rather than operating them.
Right, and that can be that's where the money can be. Yeah, it's interesting. Exxon is now drilling its first lithium well in Arkansas.
Yeah, and clearly there's no lack of lithium. I think it's kind of like uranium. There's a lot of it in the world. It's just a matter of the economics and scalability of a lot of these projects.
I guess it's a lithium brine they're working with, Exxon.
Yeah, typical brines like you see in South America and Chile or Argentina are through evaporation ponds, versus this is trying to extract it to minimize your environmental footprint. So it's certainly a more environmentally friendly process if we could get it to work.
It's salt water. They're going down about 10,000 feet. Excellent. We've got Joe in Montreal. Go ahead, Joe, please.
Yes, good afternoon, guys. I want to ask your guest about ARC Resources. I'm up about 40% over the year in my non-registered cash account. I wanted to know if he has a target price for this. Does he expect it to go over 25? And should I be adding on to it at this point? Thank you.
Great question. ARC is what I'd call one of those grandfathers of the oil and gas industry, one of the behemoths, I guess, in the Montney play in northern BC and Alberta. Very good cost control, very highly regarded management team, control their infrastructure. Reminds me a lot of our top picks are always Tourmaline at the top. They would be probably a close second. They've shown pretty good performance this year relative to its peer group. I think it's a bit of a catch-up play. And I would be very patient with this one, like I would with many other of the what I'll call premier names in the oil and gas space. I think certainly $25 is not a difficult trajectory for this stock, especially if we see prices kind of continue to creep up as LNG builds out in Canada as well as around the globe, and we see prices firm up globally.
Oh, okay. Thanks for that question. Benjamin in Chilliwack, BC. Go ahead, please.
Thank you, Andy. Dennis, my question is on Canada Nickel Company. The stock has been suffering quite a bit lately, and I'm wondering if it's something to do with tax loss selling season, or if it has something to do with the company specifically being in the nickel space. Thank you for your thoughts.
Yeah, thanks for the question. Certainly Canada Nickel is a fairly well-known entity in terms of in the development space. Mark Selby obviously has a very glorious history in the nickel space, and he's the CEO of this company. I think it's been caught up in general around nickel prices. They still are relatively weak. I would say for things to hum, you probably need nickel prices sort of in that $12 to $15 range, and right now we're under $8 a pound. So I think there's that general malaise around nickel, despite energy transition, all the excitement around things like nickel and copper. This one's a little different. I know that there's an ESG agenda in terms of a low carbon footprint that probably differentiates it a bit. But this one is probably going to move with the tide. I think we need to see stronger nickel prices before this kind of shows more of a 30 to 40% recovery at this point.
Michael is in Vancouver. Go ahead, Michael, please.
Andrew, Dennis, thanks so much for taking my call. But Dennis, my question is on Agnico Eagle. The stock basically 3 to 5 years ago hovered in the $100 range, and at one time reached over $110. It now hovers between $60 and $65, where the commodity 3 to 5 years ago was $1,200 to $1,300 announced, and now is close to all-time highs around 2,000. One dropping 30 to 40% and the other gaining 30 to 40%. Yet every analyst I research has it as either a buy or a strong buy. I have one question. Can you speculate as to what the reasoning might be based on the poor performance? And then I'll put you on the spot, Dennis. Do you like it, and do you own it?
Okay.
Sure. I have no problem starting with the last part, which is we don't currently own it. We haven't been adding a lot to our gold position because we have kind of a natural holding there through some of our specialty funds. But I will say with Agnico, it probably fits the bill like most gold companies, let's say over the last 18 to 24 months, where they haven't done much. And that is a symptom of the fact that although your timeline went a little further than 18 to 24 months, I think the sentiment has just been, at best blasé with respect to gold stocks, especially among the senior producers. We've seen consolidation, especially with names like Newmont, and this field has become smaller. But it doesn't take away from the fact that gold has been pretty much doing nothing, around 1,800 to say 1,900 on average over the last 2.5 years. And that hasn't created a backdrop of excitement for investors in order to get into even quality names like Agnico. I'm going to say it is a top-tier name, great operating costs, well-regarded management team, excellent balance sheet, and a good return of capital and a very attractive yield. But that isn't enough until we see, I think, gold break and hold over an extended period of time over 2,000 US an ounce.
Okay. Craig is in Pemberton, BC. Go ahead, Craig.
Good afternoon, Dennis and Andy. My question is just your general overall background and projection on Surge Energy, a single-digit price-earning oil and gas player in Alberta that has a market cap of under $1 billion. Thank you very much. I'll hang up now.
Thank you.
Sure. Yes, as you mentioned earlier, Surge is an oil producer in Alberta. It's been around for a long time. I've known the management team not only from Surge, but their predecessor companies. It's kind of one of those below-the-radar screen names, and I think during the out-of-favor period for this stock in particular, they kind of did a wholesale change in their asset base. And they've, I think, put together a pretty good asset base in terms of profitability and scalability. I think it's more now a matter of improving the efficiencies of their drilling and showing better margins. You know, debt reduction was kind of a focus because they're very leveraged to oil prices. And so when things were a little weaker a few years ago, they really suffered from a debt perspective, and they've done a good job to clean things up. I think probably by early 24, they can move from about a 25% return of free cash flow to shareholders to probably 50% framework. And I think that'll be good for the dividend. Right now, I think it's just over 5% in terms of the yield. So it offers a nice little yield. It's a little on the small side. It's a name we haven't owned for a few years. We've kind of stuck to large dividend payers with a little better consistency of paying that dividend rather than more of a boom and bust, pay it and then cut it completely when things are tougher. So if you're in it already, I would say it's not a bad little ride to take because we do feel pretty good about oil prices, and this is one of those more levered names to oil price.
Okay. Let's head to Lewisport, Newfoundland. David, go ahead, please. Hello, David. David, not there. David wanted to ask about Marathon Gold.
Yeah, so Marathon obviously in the news over the last week because they're the subject of a merger with Calibre Mining. You know, this is, let's say you're taking it from the perspective of Marathon. You might say, and I'm not a current shareholder of Marathon, but you could argue that this kind of takes away the true upside of the Valentine project, which is currently in construction. You would, I think, from a Calibre perspective, say, well, you're reducing the risk because we'll be a better capitalized company. It meets a bit of a shortfall in financing to complete the mine and working capital. It also diversifies you outside of Canada because I think one of their major mines is in Nicaragua. If I was a Marathon shareholder, probably a level of disappointment because I think there's significant re-rating for this stock as it completes construction. I know it's a bit of a minefield in terms of brand new single company or single asset companies building a project. It always takes longer, it always costs more. But I think this one reminds me a lot of Atlantic Gold, which was a successful producer in Atlantic Canada, successfully built on time, on budget, and the mine worked very well before it was acquired. I would have liked to have seen this at least go until construction was complete and initial commissioning of the mine before they would have considered M&A at that point.
The stock had been out of favor, Marathon Gold. Were people just getting impatient?
I think it's that classic, you know, the Lassonde curve gets overused, but, you know, in development, nobody cares. They're just waiting for bad news, things getting more costly or things taking longer and not going on stream as planned. In this case, there was a bit of a financing shortfall. I think people anticipated the gap would have to be filled. But I think that would have been easily filled given the quality of the project.
But they went with the merger instead. Yeah.
Correct.
Yeah. Gail in Pickering, Ontario, go ahead, please.
Hi, just wondering, since we're recently retired, if there is a dividend stock that ideally has some upside to the value plus a good dividend that you would recommend. Thanks.
Well, that's a very wide-ranging choice there. You know, you can It depends what commodity you want to be involved with. Look, from an oil perspective, which I think is probably the safest of all the categories, we've always been big fans of C&Q. I think they are first in class in terms of execution on their assets, quality of assets, and ability to deliver good dividend growth. And they have a tremendous track record. I think they're on the Aristocrats dividend index. If you wanted to go gassy, Tourmaline doesn't give you the upfront regular dividend, but they've been very generous with special dividends. And I think they're capable of delivering something in the high single-digit range in terms of total yield between the base dividend and the special dividends. So those are a couple of names I think that you could look at and sleep well at night on the energy side.
William is in Toronto. Go ahead, William, please.
Yes, gentlemen. I'm interested in Crescent Point. And did you participate in the new issue? One. Number two, I didn't understand the extra 2-cent dividend that you received if you held your stock November 14th. Could you please explain the situation?
All right, because Crescent Point, big acquisition, and apparently their stock issue didn't sell that well. It got hung up.
No, it was hung up, and they just had to clean up yesterday, actually, to finish off the rest of it. And I didn't get an update to see if it all went successfully, but that's never a good sign. Look, with oil below $80, I can't say sentiment has been particularly strong. You could argue the timing isn't ideal, but that's life. The acquisition was very large. It kind of reminds me, I was actually looking at the stock prior to the acquisition. I was thinking, okay, these guys are starting to build momentum. The market is starting to like them. They like the discipline. But then here comes a little bit of the old Crescent Point, even though it's a different management team, which was a very acquisitive management team, the prior one. And I think there's this concern of, oh boy, are they going to consolidate again and do a lot of acquisitions and dilute me? So I think that was reflected in the stock. I think it was down 10% the day they announced the acquisition. Obviously, the hung deal, which never helps and really dries up the market. And that special dividend, really, let's call it, it's a teaser. It's kind of like, well, this is an accretive transaction. We could generate more free cash flow. So here's 2 pennies to kind of show you we think it's something that is additive to the company, and we want to return some of it to you because of how good it is. Not a name I currently own. Like I said, I was looking to maybe add it before the acquisition, but now I'm on the sidelines because I think there's going to be some indigestion in the short term, and I want to wait and see how the market perceives the quality of this asset and perhaps some dispositions to kind of bring the debt back down because they were doing so well.
Yeah, Craig Brix, the CEO, I mean, he was with Crescent Point during its days, the old days as well, but then he was promoted. Yeah,
correct.
Yeah.
He wasn't running the ship, but
no.
I think there's just that persona that people start to worry, are the old hats coming back out of the closet in terms of acquisition binges?
Yes. Dennis was on our show April 26th of this year, so it's a pretty short time period. Headwater exploration was your first idea, not a bad pop.
Yeah, as I mentioned in the show when I picked it before, it's in that Clearwater play, kind of the hottest play in Canada from an economics perspective. Real high growth company. I mean, I can't think of anything that its yield is around 5%. It's growing 40% in 2023 in terms of production. It should be about 25% growth from its current base of around 18,000 BOE a day. Great return of capital potential. I think there's good upside for that dividend. Very well run. The CEO and founder is retiring at the end of the year, so a little bit of a shift. Somebody being promoted from within, but I don't think that changes the message in terms of this is a company that continues to expand its land base. I think only 20 or 25% of the land is exploited. There's a lot of running room on this one. I have no doubt this will probably be gone in the next year to 18 months.
Oh, just taken out by somebody?
Just taken out. It's a very good play, and I think it has very good scalability.
B2 Gold, Clive Johnson, one of the great characters in mining. This one down over the past year.
Yeah, I think I was telling you off air that, this is kind of a symptom of the space. It's very good at execution, very well diversified asset base, very attractive dividend. It's kind of top end class. I think it's around a 4% yield. We've owned it because of the yield. Again, we have a preference for yield these days, kind of bide our time. If we're going to own gold, we're going to own something like this. It also completed the acquisition of a company that we owned called Sabina Silver and Gold.
Is that in Yukon?
That's in the Yukon, and it should add about 300,000 ounces a year when complete. I think it should be in full production by 2025. So they kind of bought it midstream in terms of a mine that was in construction, already financed. It's a nice additive acquisition to a company that's already producing 1 million ounces. So we continue to hold it.
And why has it come down over the past year? As you say, it's just a symptom of the intermediate golds out of favor?
I think valuation is part of it. It does trade at a premium to its peer group because of its historical execution and excellence. So it's not a surprise that a little bit of that bloom comes off the rose when sentiment turns, but it still does trade and preserve that excellent value for shareholders relative to its peer group.
Okay, and then finally, Trican Wealth Service, quite a rally in this name. Is that to do with debt restructuring, or what happened there?
Well, now it is essentially debt-free, and it's a company, it's kind of a pure play on fracking services. And I think the outlook is quite strong for the future in terms of in Canada and even in the US in terms of well servicing. It might not mean the well count goes up, but a lot of resurfacing that goes on. People are discovering you could go back in and refrac wells to improve productivity. And they are very well positioned in that space as a very nice yield. Again, another theme of ours is to own it because of the yield. And I think the very strong upward bias towards fracking services and intensity of fracking services.
Andreas is in Calgary. Go ahead, please.
Hello, Dennis. Thank you very much for taking my call. I tell you, I'm interested in the iron ore sector of the economy, and with this stock in question, Cleveland Cliffs, CLF. I'm just interested on your thoughts about the sector and that company, particularly, and I'm just going to hang up and listen to what you have to say about that. Thank you very much.
Thank you.
Thanks, Andres. Yeah, iron ore, a very controversial space in the sense of, like many steel-making inputs like met coal, certainly a bit of a roller coaster ride. And Cleveland is very high beta to how iron ore does. And it's very dependent on, obviously, China, because they are the largest producer of steel. And so that's an input into steel. We don't own Cleveland Cliffs. We have been in and out of some iron ore names like Labrador Iron Ore because of the nice dividend, although we've been trimming over the last several months. Cleveland, again, doesn't have the same kind of dividend that, say, Labrador Iron Ore has. The operation is in Minnesota, nothing wrong with that. But it's just a name that didn't offer the same sort of dividend coverage that we're kind of looking for, at least for a little bit of protection when we're biding time. I think iron ore is a little bit more volatile now because of, let's call it the false start on China and concerns about the economy in China and whether they can recover, as well as the global economy. I mean, Europe is the #2 steel maker, and they're certainly teetering on, an economic slowdown. So I think a couple of major sources of steel production and consumption are showing signs of some weakness, or at least delayed recovery, and that doesn't bode well for iron ore. And it's certainly come off of its highs. It's, I think, trading around $115 a ton, well off, I think, the expectation that it could have been closer to 140 or 150.
Okay. Daniel is in Markham, Ontario. Go ahead, Daniel, please.
Hi, Andy. Hi, Dennis. May I have your thoughts on Baytex Energy? And what entry points and opportunities would this be a buy, as well as other Canadian heavy oil stocks? Thanks for taking my call.
Thank you.
Well, Daniel, your question gives you a reason to wait till the top picks, because one of my top picks will be a heavy oil producer, one that I prefer over Baytex. Certainly the one I like is more of a pure play. Baytex is no longer just a pure play on heavies. We also have a preference for, let's call it scalable heavy oil projects, steam-assisted projects, mine projects like you see among the fully integrateds or seniors. Baytex has just been one that seems to come in and out of favor depending on leverage to oil and where the oil outlook is. we're kind of leaning towards the names that, although they are not immune from what oil does, their performance is, I guess, a basket of how oil does, as well as their own operations and ability to generate very strong margins and scale that up over time. And I think you'll see that with one of the top picks later in the show.
Okay. We've got Jean or Jean from London, Ontario. Go ahead, please.
Good afternoon. Dennis, I'd like your comment on Northern Dynasty Minerals. Apparently they have a large deposit in Alaska. If they ever get to full production, could I have your comments, please?
Thanks.
Andy and I were talking about this off air. I mean, this is a long-running saga. Their project, the Pebble Project in Alaska, barring a significant change in government, both federally and at state level, I just can't see this happening. The environmental sensitivity is so high. The EPA, you name it, everyone's been involved with this one. So this is one of those things you could kind of sit on the vine and wait, or you can move on and find companies that just have a good project that is financeable and could participate in the commodity today rather than trying to see if you can participate in the environment 4 or 5 years from now.
Okay, yeah, that's going to be, I mean, because there's local, they say it'll damage a salmon river and yeah.
It's just one of those things of why. I mean, I could name other companies that have massive resources that you could debate whether it ever gets built, but they don't have the same sort of opposition like you do with Northern Dynasty's Pebble Project.
Jim in Whitby, Ontario, go ahead, please.
Hi, fellas. Just want to ask a question on Enbridge. Just looking for its projection over the next quarter to a year. Thanks. I'll hang up.
Thank you.
Yeah, Enbridge is sort of a staple at Middlefield. We actually created a fund all about Enbridge. It's called eSplit. And the whole idea was Enbridge has such a stable, growing dividend and such a reliable underlying business in pipes and renewables and so forth, that we decided, well, let's carve this up. I think at the time it was a 7% yield 5 years ago, and we said there are people who just kind of want the guarantee of the underlying principal. So we did a pref that's $10, and you get a 5.25% yield on it. And then there's the capital unit, which participates in all of the upside for Enbridge, both in the upside of the stock as well as in its yield and distributions increasing. So for us, Enbridge is just one of those things. You put it away, you go to sleep. It could be frustrating at times. It's an interest-sensitive stock, and the most recent acquisition was of utilities in the U.S., and that certainly didn't help. The equity deal went well, and I think this is something that will recover as we sort of see in the second half of 24, interest rates start to get cut. I have no reason to believe this won't be back in with a 5 handle again by late 24.
Okay, above $50. Stephen is in Hamilton, Ontario. Go ahead, Stephen, please.
Oh, thank you for taking my call.
Pleasure.
I would like your guest outlook for natural gas for the next 6 to 12 months and beyond. And does this explain the recent drop in the price for tourmaline? Thank you.
Thank you.
Now we got a double header. So natural gas, this is the transition fuel. I think we've all recognized 2 things have materially changed. Security of energy, and obviously with the Russian invasion of the Ukraine, I don't think you could turn that clock back. The reality is people are looking for more natural gas to replace what is falling off from Russia, because that relationship isn't changing anytime soon. The U.S. and Canada are uniquely positioned to satisfy that gap through LNG. The U.S. has had a head start, but I think Canada, with LNG Canada coming on in 25 and 26, will start to catch up, at least on a relative basis. One of the names you mentioned, Tourmaline, is involved with another LNG project as a shareholder and a participant, not LNG Canada. But I think it will naturally benefit from the ability to break out more Canadian natural gas beyond our borders. Now, Tourmaline is unique. They do have access to the Gulf Coast with Cheniere. that ships to the Korean market and gets very favorable pricing there. And they have good egress into places like California. So they're unique. It's been a frustrating stock as it is our favorite name in the space period because of the ability to generate good yield from both base dividend and specials. But I think it's just one of those where it's been so good, it's so well owned, it's harder to find new hands to buy it because it's such a staple in the energy space.
Okay. And natural gas generally, a brutal winter is what the price really needs to rally it.
Yeah, look, let's put aside weather, which is obviously a big wild card in the short term.
Sure.
It comes down to the world needs more natural gas. North America has plenty of it. There are a few players that are going to be major participants in that upside, and I think it just revolves around natural gas and LNG build out in North America. I think the stat that we came up with in Canada is that we're probably going to see Canadian natural gas production have to probably increase 30 to 50% by 2030 in order to satisfy LNG demand.
Wow. 30 to 50%. That's pretty big, all right. John is on the line from Sault Ste. Marie. Go ahead, John, please.
Yes, I own First Quantum. Just wondering, should I sell or hold on or buy some more?
Thanks.
You know, it's interesting. We had this conversation internally about points of downside and whether you have to make a hard decision. You either sell it all, or if your conviction is still there, you double up, you add to it. There's no use sitting around unless your viewpoint has changed or it's higher conviction for you and the market is just wrong. First Quantum, I think the issue is quite clear. Panama, there have been several constitutional challenges in the courts. I think November 22nd is when the courts will opine on it. I think they're trying to maybe do a referendum on the 17th, and this all revolves around the new contract the government negotiated with them around their big Cobre Panama mine, which I think is 50 or even 60% of net asset value. So the stock was down 50% in early October, I believe, or early November, I should say, around this fight. And they are winding down operations, it appears. So it's quite material to the company.
Or temporarily.
Temporarily. Who knows?
Because
there's a lot of social unrest. There's blockades at the port with ships and so forth. So I hate to say it, it's one of those things where I can't predict the social environment or the government will, or even what the courts will say. That's just a black box.
Yes.
It's not about, hey, is the mine working well? Is there a technical issue? Oh, we need to spend a little more capital to increase the crush rate. All these various technical issues that to some degree is within the company's control. This is out of their hands. I would argue, yes, maybe there is some resolution, but then something comes up 6 months later or a year later. So I would just say move on. We haven't owned the stock for a number of years around this political risk. And it's like Northern Dynasty earlier. Why do you want to fight this uphill battle? It could be a lottery, and maybe this thing, goes up 40% if there is a favorable outcome in the next few months. But you're probably going to face something again down the road. The social environment in many of these South American countries or Central America countries is quite negative. Everybody wants more. People want more environmental responsibility. And that's a very dangerous environment as a shareholder. So if I owned it right now, I would move on to something else and just have a little more visibility and comfort and sleep better at night.
Okay. We have an email from Richard. Richard is asking about a newly listed company, Strathcona Resources, just combined with Pipestone.
Yeah, so it just went public through a, let's call it reverse takeover of Pipestone. It's a weird mix. We talked earlier about Baytex and one of my top picks. Okay, heavy oil that also has Montney gas. It's kind of an odd one. It's a fairly substantial producer. I think it's the 7th largest producer in Canada. It's almost 200,000 BOE a day. We don't own it. We didn't own Pipestone before. I would rather have more of a pure play because these are very different dynamics between heavy oil and, say, gas on a macro front, as well as the types of plays that they are. There's really no synergies between them. So I would rather just own a really good heavy oil company and a really good gas company like my top pick or a Tourmaline.
Oh, okay. Jeff has sent us an email. Jeff's curious about Tamarack Valley. What are your thoughts?
Tamarack suffers a bit from what we talked about earlier with Crescent Point and maybe even Whitecap for a period of time where they were in this acquisition binge. And they haven't done one in, I think, 2023. After a pretty heavy 2022, they've kind of been going through debt reduction strategies, so a little less return of capital to shareholders and more towards the debt. I think 2024 will be an inflection point, and I'll probably use that term a lot, but 2024 will be an important period where they reach certain hurdles on their debt, and that allows them to shift up on their return of capital framework so that they can pay more out to shareholders and increase their dividend and maybe even do buybacks. So I know one of my colleagues in the office has owned the name based on that inflection point coming in 2024.
First idea, as advertised, Meg Energy.
So I mentioned to, I think it was Daniel earlier in the show, about waiting for a top pick in the heavy oil space, and this is mine. This is a 110,000 BOE a day heavy oil producer, so we'll call it an intermediate. These are long life, low decline, very scalable assets, easily achievable to double this production base because of the size of the resource. We've owned this for a while now. It's been a very good performer, one of those highly leveraged names to any upside in oil, kind of like an Athabasca, but a much bigger company. It's a pure play, which is why we liked it. There's no dividend, but I do see greater visibility as they meet certain debt targets. I think their goal is to get to $600 million, and then they can increase their return of capital to something closer to 50%, maybe even 75%. And they'll probably do that primarily through buybacks rather than maybe the introduction of a dividend, because there isn't one. So this is one of those rare ones I'll talk about that does not have a base dividend like everything else I'd like to talk about on the show. But it is a very high quality asset. Might be, and it's always rumored to be, an M&A candidate for Suncor, because we know the base mine is coming towards an end, and how do they fill that gap? Obviously Fort Hills and the acquisition recently helps to fill some of it, but all that infrastructure, I think this asset would be prime because it's 110, and I could easily see it in a larger company's hands over the next 10, 15 years, getting to 300, maybe even 400,000 barrels of production per day.
Okay. Sorry, where could you see it getting to?
I could see it tripling or quadrupling in terms of that asset-based production base.
This is Meg.
This is Meg.
Wow, I didn't know they were that big potentially. Okay, well here's the company in the news, Teck Resources.
Geez, we can almost take an hour on this one. So I think I came on for a short segment several months ago when they were in the middle of this battle with Glencore, and were they going to be able to execute their own business plan of separating the met coal business and the base metals business run predominantly by copper, or whether Glencore is going to successfully acquire them. And neither one won because they were voted down on their proposed split, and Glencore obviously didn't win. They decided to go down the route of, well, maybe we'll sell the business, which is Elk Valley Resources. And they just announced a couple of days that they were going to sell it to Glencore. A little anticlimactic. I think if people always assume there's going to be about $8 billion US. They got $8.6 billion, and probably another billion on top from operating cash flow by the time it closes in the third quarter, they anticipate, of 2024. So kind of in line, but I think this takes a really big overhang off the stock. I know the stock doesn't seem to show that, and we talked off air about, the stock has been weak today in particular, and didn't show much enthusiasm yesterday compared to Glencore's stock being up, is I think the regulatory hurdles, perhaps the market is concerned. We talked about coal workers and the union asking the BC government to exert significant scrutiny on this transaction.
They're not thrilled about Glencore coming in and slashing and burning, maybe?
Well, look, I'm sure Glencore will say all the right things. I mean, it's not like they decided to enter into this in the last month.
No.
They've been working hard at this, and they have their own game plan of spinning out the coal assets as an entity within their organization. So they're going to say the right things. I'm sure they will appease everyone's concerns. Whether they act upon it over time, who knows? and what kind of strings you can put on this kind of a transaction. But for Teck on its own, as it's called it, Teck Metals, which is what they're proposing the name change to be, I think this clears the hurdle, makes it a pure play on base metals, you know, the whole energy transition concept. And the copper outlook is great. QB2 is on track. I know capital has gone up a couple of times, but we could see the goalpost. So the sweet spot is this. They're going to be debt-free, probably $3 billion of cash in the bank, and QB2 will be in full stride by the end of 24 and in free cash flow mode. No new major initiatives for growth probably till 2026. So I kind of think late 24 and 25 will be a sweet spot in terms of return of capital to shareholders and operations really humming in terms of free cash flow.
Yeah, Jeffries, I think it was Jeffries said yesterday that there could be $5 billion in potential returns of capital ultimately.
Look, I look at this thing being probably a $70, $75 stock by early 2025.
I'm not sure if the viewers could hear. They're testing the emergency system there. I turned my smartphone off prior to the show. Denison Mines is your final idea. This would be one of your favorite uranium plays?
Yeah, this one's different. Look, we can always go buy a Cameco if you want the behemoth and the most leverage to uranium prices. But Denison is unique. We talked about E3 lithium earlier, about a new technology that has not been used outside of China. In the case of Denison, they are looking to use in situ recovery methods, which is used in the US, and it's used in Kazakhstan, for example, being the biggest producer of in situ recovery. So it's basically recovering uranium from underground using, again, chemicals and water to bring it up to ground rather than evaporating ponds like you see with lithium in South America. It's interesting because they've done a lot of technical work. I think it's largely de-risked. The technology is well proven globally. And I think this is one where they took an asset that wouldn't have been economic, even I'd say maybe at today's prices for uranium, using conventional technology. This has really brought down the capital requirements, probably $400 million to build this, $420 based on the last feasibility study. Operating costs would be around $16 a pound versus, you know, uranium's around $75 right now in terms of the term market. So very strong economics. The feasibility numbers showed, I think, a 90% IRR, which is quite impressive. So it is almost fully financed because the uranium they have in the ground or the uranium that they own in inventory plus cash, there's probably $50 million that they have to raise. So it's one of my favorite names in terms of leverage to uranium, and I think it's a prime takeout candidate.
Dennis, thank you very much indeed.
Pleasure, Andy.
Dennis De Silva has been our guest on Market Call. Thank you very much indeed for watching our show.